With many other deals happening in the sector, the big issue of the moment for you is the takeover discussions. Why is the board continuing to recommend the 888 offer when there appears to be a higher bid coming from GVC?
Well, as you know, we have been working with GVC and their advisors to try and help them resolve certain key aspects of their proposal, something they have now done. We have now asked them to clarify the best terms on which GVC is prepared to make a formal offer to acquire us. There can be no certainty that GVC will make an offer. However, 888 has been informed of this development, and if appropriate, we will give due notice in the event that bwin.party proposes to recommend an offer from GVC. In the meantime, the directors' unanimous recommendation of the offer from 888 remains unchanged.
It's obviously good to have two interested parties bidding for you, but why has it taken so long to get to this stage?
Well, these things take time and they are complex by nature. Whilst it has taken some time to get to where we are right now, it's clearly not about the journey, it's clearly about the result. And the recommended offer from 888 represents a substantial premium to the group's share price before discussions began in earnest. Whether there is a subsequent higher offer, we will have to wait and see.
So what happens next? What's the timetable and when do you think we'll see a deal concluded?
Well, we issued a statement yesterday updating investors on where we are, namely that we are seeking clarification from GVC on their best terms and on which GVC is prepared to make a formal offer to acquire us. We expect to provide an update to the market on September 1st.
Given the length of time that these deals take to complete, how hard is it for you and the team to remain focused and motivated in running the business at 100% until then?
Well, I won't lie, it was not easy and it is not easy, but we are fortunate to have a very professional senior management team who is focusing on running the business. And from the very beginning, when we started on this journey, we split tasks. On the one hand, our operational management running the company, and on the other hand, the executives together with the board running the process. Now, as evidenced, we have actually posted good numbers in the first half year of 2015 and have increased our EBITDA, clean EBITDA, by 2% against very strong headwinds coming from UK POC tax and European VAT and a lack of a World Cup, which we didn't have this year. Had we not on a like-for-like basis, we would have actually increased EBITDA by 24%.
You touched on the results there. Do you think the company has finally turned the corner and is now returning to growth?
It has been definitely a long, drawn-out and very difficult journey which we went through over the last few years. And especially shifting from a very simple .com regulatory model to a .national, multi-channel, multi-product and obviously multiply regulatory framework. Now, that has been difficult, but we have made a lot of progress, especially over the last 12 years. We have reset our cost base, we have simplified our business approach, and we are now at the point where we should be able to see growth in most of our businesses going forward.
So what are you most excited by in the performance and what still needs work?
I guess that's definitely the area of technology. An area where we had a lot of problems in the past, but just lately, because we made some management changes, we have brought in some top engineers, and now the company is engineer-led, which is something which we didn't have for many, many years. And those engineers who are managing our development centers in India and Ukraine and Austria are being complemented by by product and commercial experts. And that is a formula which has helped us to take out cost and at the same time increase efficiency dramatically. We are now at a point that enables us to enter new markets much more quickly and much more efficiently than in the past, and at the same time we are able to take on new B2B customers. So that's something which should really help us going forward to improve our performance substantially. There are other areas where we have done a decent job. Obviously on the non-core area, Martin has talked about it, or will talk about, that we have pretty much completed the sale of non-core assets. There are still a few non-core assets, Calix and Intertrader, where we have decided for the time being to rather invest into them, because both are profitable and both have still a lot of potential going forward. And obviously, last but not least, we will need to see growth in our marketing units, both on the sports labels and on the games labels side.
Mobile is seeing growth across the business, but are you happy with the level and speed of this growth? More specifically, can you deliver on your 2014 target to achieve 50% of gross gaming revenue from mobile touch devices by the end of this year?
Well, mobile is the key battlefield for any online gaming company today. Who gets it right will be a winner, who will not get it right will lose that battle. We have made, again, a lot of progress over the last year. And especially for a company like us with such a diverse geographic footprint, that was a huge challenge. When you look at sports, for example, we have already almost hit the 50% target. We are now sitting at about 47% of gross gaming revenue in the first half. In casino, we have doubled it to about 19%. In bingo, we are now at 33%, so I'm confident that by year end in bingo we will be there. The area where most likely we will not hit it is poker, where we are currently at 9%. But overall, as blended rate, I think we have a chance to get close to or even to 50% by the end of the year.
You finally completed the last part of the technology integration. Does this mean that you'll focus on product innovation, or will the team simply be redeployed on integration in the next consolidation?
Well, obviously, because we have now completed integration, we have a lot of resources and bandwidth available to now work on other projects. As I said before, we are now on the brink of entering newly regulated markets, so we will need manpower to build all these labels for those national regulated markets. At the same time, we are in discussions with new large B2B customers, and we may even be able to leverage our technology power by selling technology solutions to potential B2B partners in new markets as well. So in general, we have taken also cost out in the past. So let's not forget, we have reduced our workforce in studios now to less than 1,000 people, coming from about 1,500 in the last 12 months. And even in any post-consolidation combination, we will need that experience and manpower to again actually integrate those businesses efficiently.
The operations in the United States are noticeably downplayed in the results release. What's going on there?
It's clearly a result of a slowdown in regulation in new states coming online. The last 12 months we have brought our cost base down in New Jersey. It's more about a profitable wait currently in the US for a new state to regulate. And as long as new states don't come online, it's basically something which we are managing very carefully. So there's just no news right now in the US.
Staying with regulatory issues, should we be any more concerned than before about Germany, where there are regulatory issues? It remains your biggest market.
Not really. I think we have predicted regulatory developments in Germany very well over the last years. Unfortunately, it's still not clear what's going to happen in Germany. The licensing process is stuck in local courts for the time being, and there's no clear visibility when that will change. When you take a mid to long-term view on Germany, I'm very bullish that at some point Germany, like its neighbors, will launch a modern regulatory framework, and at that point we will be very well positioned to take advantage of that development. Germany is our biggest market. That's where our roots are to a certain extent, and once Germany regulates properly, this will be a market of substantial growth for us.
You say you're planning to enter Romania and Greece later this year. What size of markets do you expect them to be? Greece in particular was sizable, but what impact will the financial and political turmoil have on betting and gaming volumes there?
It's correct. Greece was a big market for bwin especially, and it's not that important to foresee how big those markets will be for us. What is so important for us that we are finally able to re-enter markets which previously we had to close down. So going back into new markets, being Romania and Greece and potentially others, is a huge opportunity for us, and it's the first time after many years that we will be able to increase our footprint again. How big it will be, we will see, but it definitely will be contributing to our margin.
Looking at the figures, the clean EBITDA growth seems to have been driven almost entirely by the bwin labels and non-core businesses. Is this a fair picture?
Well, they were certainly, I think, the two main drivers behind the growth. In respect of the non-core businesses, we made significant progress in cleaning those up. So we sold certain businesses that were loss-making, such as Win, Winners, and also the World Poker Tour. And we managed to move the non-core businesses from generating an EBITDA loss last year of 8.4 to EBITDA positive of 2.1 million in the period. The bwin labels also performed strongly. Clean EBITDA was up by 14% to just over 40 million euros. And that was despite the fact that we had the World Cup last year. And that was largely driven by costs that we took out of that business. With respect to the games labels, they had significant headwinds this year. As you're aware, we had the point of consumption tax that came in December 2014. So that was one headwind that hit games labels in particular. And we also had the introduction of EU VAT. In respect of studios, their EBITDA loss increased slightly from 10 million to 11 million euros. But that's very much down to the fact that the revenues from internal clients dropped off. The actual underlying cost base of that business was also taken down. And for us, it's all about getting that business to scale. We've got a very substantial pipeline of new customers, and we expect to make further announcements in respect of new customer wins in the second half, and they should transform the profitability of that unit. In respect of corporate costs, they were pretty flat, but actually if you look at the underlying trend, net of FX, it was downward. And
are you confident that growth in the core business can be sustained?
Yes, this year was impacted by the introduction of the point of consumption tax and also VAT in a number of European markets, and that impacted the headline growth rates that you saw. The growth rate we reported of 2%, if you strip those items out, you'll see that the underlying growth rate in EBITDA was actually 24%. And then looking forward, of course, we've got continued growth in mobile. Our proportion of revenue coming from mobile continues to grow every year. We've got the prospect of moving into some newly regulated markets. We also have the benefit of the European Championship next year. So I think things are looking very rosy on that front. On the studios front, we have, as I mentioned before, a very healthy pipeline, and the addition of some substantial new clients will significantly benefit the profitability of that business unit going forward. So we are optimistic about the outlook for the business.
You've mentioned the introduction of the UK's point of consumption tax and this year's introduction of European VAT. Excluding any extraordinary one-off fees for entering new regulating markets, do you think you're now seeing all the taxes you're likely to see in regulated markets? What I mean is, do you now have a predictable and stable tax playing field for the foreseeable future?
Well, I think it's inevitable that as and when more markets move to national regulation, that there will be additional taxes that come with that. But as you would have seen, already 60% of our revenues are coming from regulated and or tax markets. So the incremental impact going forward will be more limited than it has been in the past.
You say you're ahead in your cost reduction plans. Can you be a bit more explicit here?
Yes, well, we gave a target of 15 million euros of additional cost savings for 2015, and as at the half year, we had reduced administration expenses by 8.8 million euros, so we remain well on track to hit the 15 million cost saving target for the full year, and we expect to exceed that. And in addition to that, we also made some significant savings in respect of distribution expenses. Primarily in the form of marketing expenses and chargebacks.
But is the decline in marketing costs actually also down to the change in strategy away from sports sponsorship to direct and targeted online marketing? Or is it all about the lack of a major football tournament and reduced marketing in New Jersey?
Well, it's not one specific factor, as you're alluding to. I think that is correct. Certainly we are reducing our reliance on sponsorships, and as and when these sponsorship agreements are coming up, we're reassessing whether or not we renew those. And certainly there's more of a shift to what I would call to action marketing. But then, as you rightly say, last year we had the World Cup, and we had significant marketing expense around the World Cup last year, primarily impacting the first half. We also have reduced our investment in the US market. The reality is, for everyone, it's turned out to be a bit of a disappointment in respect of the rate that the US market is opening up, and also the size of the New Jersey market. So we've taken the opportunity to basically kind of right-size the cost base for our US business, and that has involved reducing the marketing in that area as well. And then affiliate expenses have also reduced in line with our goal of reducing the reliance on affiliates.
The gaming labels have focused their marketing on the UK in this half, with, it seems, some success. Why did they do this, and is this something that you can replicate across other markets?
The gaming labels focused on the UK market for a number of reasons. First of all, if you look at some of the brands within the games labels, the primary brands of Foxy Bingo, Party Poker, Party Casino, they're very strong in the UK. And the UK market itself is the biggest online gaming market, certainly the biggest online gaming market that's regulated. And it's also growing strongly. So they took a decision to focus on that market, and I think it's as you can see in the results, it's paying off. Our revenues in the UK were up by 11%, and in casino and poker, you had casino was up by 19% and poker up 17%. Sports was down, of course, because we didn't have the benefit of the World Cup this year, and because our margin is below normalised levels, as some other operators have also reported.
Do you plan to try and sell off the other non-core businesses before any consolidation deal is completed?
Well, the remaining businesses that are within the non-core segment that we report are Calixa and Intrader, and currently there are no plans to sell those business units. Both of them are showing strong growth, both in respect of revenue and also improved EBITDA.
You have a great deal more cash now. Why not a larger dividend, or is an agreed level of cash part of any consolidation deal?
Our net cash increased to 58 million euros in the half. So it's true that we do have a healthy net cash position, but we have announced that we're going to increase the dividend by 2% to 1.92 pence per share. And that is subject to a limit under the terms of the cooperation agreement with 888, and it's also the case that there is a limit on the amount of dividend that 888 can also pay out.
The dividend increase is pretty modest though, given your confidence about the outlook. Should we read anything into this?
No, I don't think so. I mean, it's true we've typically increased the dividend by around 5% per year, but you know, as we've just covered off, the reality is that that dividend level is subject to the cooperation agreement, and that's really what's determining the level of the dividend increase. It's not a read on our confidence in the future.